According to our next guest, 2016 presented one of the most volatile and unpredictable periods for energy markets, with lows of $26 a barrel to highs in excess of $50. We didn't know almost from 1 month to the next what OPEC was going to do next. But how has this played out in the small cap space? With more, we're joined now by Angelos Damaskos, fund manager of the Junior Oils Trust. Angelos, welcome. Interestingly, I noticed actually your fund, the Junior Oils Trust, for the last 6 months has been rated as #1 by Morningstar. And I think over all the last year, you were number 3. Right. With all that in mind, what's 2017 looking like?
Well, I'm very optimistic for 2017, and it's all on the back of recovery of the oil markets from the extreme lows we saw early last year. And the reason is not only OPEC and the supply cuts they have promised, and they are actually starting to deliver, but it's more to do with the fundamental contraction in supply as a result of the draconian cuts in capital expenditure that the industry bore through the extreme crisis. So by very reputable and very solid forecasters, we expect this year to be the first supply shortage in the oil market, and therefore start drawing on the very high inventories that have been accumulated so far. But more importantly, there are some very reasonable forecasts pointing to up to 1.5 million barrels per day shortage by 2020.
I think we've got a chart showing this. I think if we can bring up the chart to see exactly where things are, we can see how the global supply has outperformed demand up to that 2016 period, and that crossover that you're talking about.
Yeah. So what the OPEC cut has done is that it has shifted the correction of supply-demand balance earlier, perhaps by 6 months. But the underlying fundamentals indicate that there is a significant destruction of supply in 2 or 3 years' time from now, and that will be apparent in perhaps a few months, and therefore the market has started pricing in higher prices for oil. Another indication we look at and follow is the net length of the speculative positions, and this is what the short-term traders do to take advantage of movements in the oil price. And we see now that the net length, which means longs led short, has increased to the highest level since 2010. So the market is very, very confident that oil prices will remain in an uptrend trajectory. So we have now shifted to a trading band of between $50 and $60 a barrel. We think that by year end, we will have probably shifted in the band of $60 to $70. And let's see where it takes us next year.
Your most recent report, I know you say that 2017 has started well. Just going back to the stat I gave at the top about the fact that over the last 6 months you were #1, and over the last year you were #3. What's that say about the small cap space, which is where you are dedicated?
Yeah. Well, traditionally and historically, the small caps have tended to underperform the market in times of bear market and outperform in times of bull market. We are coming through this extreme crisis early of last year, and towards the second half of the year, the large caps outperformed because investors sought safety in value and size, and ignored the smaller capitalization companies that are perceived more risky. Now, towards the last half of the year to date, we have seen the small caps catching up with the valuations of larger cap companies, and that's the reason our small cap focus fund has outperformed over 6 months everyone else, but is also coming up in the rankings over the trailing 12-month period. So if we are right about the assumption of oil price trajectory, we will expect this outperformance of small caps to continue over the next year or possibly longer.
Going back to that trajectory, what would you say to those that suggest that as the oil price goes up in this situation that we'll get more US shale coming on, which I think has been one of the fears for OPEC, hasn't it, that when they start to cut, price goes up, US shale comes back in, the price drops again?
Absolutely. The US shale is the most price elastic part of the industry. The industry has identified where the reserves lie, how much it costs to drill, how much it costs to produce. So it's a very simple decision as the oil prices elevate to a next plateau to take a decision to drill more and accelerate production. So US shale production, North American production, will increase very quickly, quicker than anywhere else. As the oil prices recover. But the destruction in supply is happening in other parts of the world where we have longer term projects that require a lot of capital expenditure and long lead time decisions, such as the Brazilian pre-salt, such as the tar sands in Canada and other places, perhaps offshore Mexico. All of these things will take a lot longer to re-accelerate the capital expenditure and development, and therefore lag the price rises of oil. And these are the supply drops that will cause this shortage in supply demand 2 or 3 years down the line.
Okay, let's take a look at how the Junior Oils Trust is made up. We've spoken to you before about this, and I recognise a number of companies. If we can bring up the top 10 holdings, I recognise a number of companies here we've spoken about before. I think Questerre Energy is your biggest holding at 10.1%, Cooper's at almost 7%, and all the way down to Painted Pony, the smallest of this top 10 at 3.7%. So you can see roughly the sort of spread. Just explain a bit about what you've got in the top 10 here.
Well, Questerre has been a notable outperformer last year, particularly in the last quarter of the year, because the National Assembly in Canada approved the fracking of hydrocarbon drilling in Canada. And that's particularly important in Quebec, because Quebec is a net importer of gas. And Questerre is one of the largest landholders in partnership with Repsol, the oil major over there. Questerre holds 25%, Repsol 75%. But it is particularly important for Quebec to develop its domestic regional resources that will be incrementally very, very economically beneficially. So Questerre controls in the region of just under 1 billion barrels of oil attributable to them, which have hitherto been rated almost at zero in its valuation. So once this law has become effective, and now in the next few months we expect the actual procedural legislation to come into force, they will be able to start thinking about drilling this with Repsol and monetizing the value of that asset. Hence why it has outperformed so massively. But in addition to that, it has very important Montney-focused assets in Alberta, which are currently cash generative. They produce about 1,500 barrels of oil per day. So by virtue of the profitability of these assets and the drilling expansion, it has a significant cash flow that is sustaining the operation.
This is the biggest holding you have at 10.1%. This 377% rise in its share price during 2016, has that taken it up to 10.1%? Or do you sell down when you get a stock that dominates like this?
Typically, we do tend to look objectively at the valuation once a company has had such a stellar run. But in the case of Questerre, we haven't sold a share yet, because we think that the valuation of this massive asset in Quebec is yet to unfold. And I expect significant outperformance in the year to come.
Okay, the second one you've got is Yangara Resources. What do you want to tell us about this? Again, I think it's Toronto listed, isn't it?
Toronto listed, and that's a much more conventional operation than Questerre. The reason for its outperformance is that it has proven its sustainability and its business model in the severe depths of the bear market last year. I.e., they managed to keep all their debt covenants current. They managed to preserve the cash balances of the company and the operations. So as the oil prices started recovering, they were in a very good position to re-accelerate drilling and increase the production. They expect this year to produce between 4.5 and 5.5 thousand barrels of oil per day. But they have a significant resource base that we believe is not correctly valued in the enterprise value seen by the market cap. And also they have a very prudent balance sheet. They only have about $65 million of debt, which is very easily covered by the cash flow generated at the moment, at about 1.2, 1.3 times cash flow per debt service. Per the entire debt. So it's a very prudent operation and a very solid company that will continue to grow.
On your expectation that the oil price is likely to continue this upward trajectory, do your parameters change at all for the Junior Oils Trust? I think we've spoken about this before. You go for relatively safe jurisdictions. You go for companies that have proven track record of production and so forth, these safety nets. Do you find yourself looking outside of this for more opportunities? Perhaps maybe you can get some more traction for gains, or do you stay with your knitting, as one would put it?
We generally tend to stay with our knitting, because this has served us well through the weak periods of the market. But where we do adjust positions and where we have adjusted the portfolio during the course of last year was to eliminate and take out the positions that looked very vulnerable with the bear market, with too much debt and too low profitability at the low oil price environment. So by taking out those positions, we avoided outright losses and some bankruptcy situations. But going forward, we do focus on the more prospective situations, such as Quester, such as Yangara, and others that you see in our top 10 positions that have the capacity, have survived the bear market for a start, and have the capacity to grow and prosper in the bull market.
Well, we wish you luck for 2017. Look forward to speaking to you again later on in the year. Angelos,
you,
thanks for joining us. Angelos Damaskos, Fund Manager at the Junior Oils Trust, talking to us there about the value of small caps in this part of the cycle.